Hello and welcome. I'm Morgan Larson with the Bliss Real Estate team, and we are talking 2023 mortgage interest rate forecast today. So what is going to happen to our mortgage interest rates? So let's start right off by saying, hey, 2022 was kind of a crazy year. I'd say volatile was definitely the word of the year. Relentless in going from a 3% average 30-year fixed rate mortgage to over 7% in the beginning of November. So buyers were very uncertain about what to do and what was going to happen. And sellers, of course, thought it was still 2021, and it made the whole year a very different market than 2020 and 2021. So what's going to happen here in 2023? Well, first of all, I would say that you gotta know that even though I'm quoting averages, all mortgage interest rates are gonna be dependent on your individual credit score and other factors. So I am talking averages here. Economists have a couple different viewpoints. So some are saying, hey, I think that we're gonna be stable and not too volatile. We're gonna see the rate sit between 5 and 6% all year. And other economists, because everybody has differing opinions, are saying, hey, I think we're going to see some additional rate hikes this year. Now, all of this, of course, is that they can't know what exactly is going to happen with our overall economy and with inflation. And all interest rates, but mortgage interest rates as well, are tied to inflation. So last year, what we were seeing was that the cost of everything to buy got more expensive. We'd all been talking about it actually for a couple years. Cost of lumber, cost of food, etc. Most recently, cost of eggs, which of course is tied to other aspects. But everything seemed to be getting more and more expensive. So that's inflation. And when those rates go really quickly, the Federal Reserve, who's sort of in charge of keeping our economy as stable as they can, whatever your opinion is on it, that is their job, they usually react by changing the cost of money. As in, they will change the baseline interest rates for the banks to borrow money. And when they do that, there's a trickle-down effect that causes our mortgage interest rates to go up. If it's more expensive for the lenders to borrow money, then it's going to be more expensive for you to borrow money. So as inflation goes up, the feds want to chill that out, and so they raise their rates, and then the mortgage interest rates go up. And last year, what we started to see is by the end of the year, what they had done actually worked. So they weren't trying to necessarily raise the mortgage interest rates, but they were trying to cool down inflation. And it has subsided a bit. It has stabilized a bit. And so if that remains stable, then the economists who are saying, hey, our interest rates are going to be between 5 and 6%, our mortgage interest rates, they'll be correct. And if inflation does not remain stable and the Fed then has reason to continue to change the rate, then of course we will see that affected in mortgage interest rates as well. Overall though, it does seem like we are hitting some stability. Mortgage interest rates have calmed down, inflation has calmed down, so all signs point to the rest of this year having minimal ups and downs and being much more stable and much less volatile than last year. If you have questions about how this affects you, whether you're buying or selling, please don't hesitate to reach out. I'm sure it generated some questions and I'd love to answer those for you. So just give me a call or send me an email and we can connect. Take care and have a wonderful day.